Good morning and welcome to the latest installment of the Austin Associates webinar series. During today's session, we will review commercial lending trends for 2014 and look forward at expectations and strategies for success in 2015. My name is Jeff Morris and I will be presenting today together with Andy Morgan. Andy and I are both managing directors and principals in the financial management division of Austin Associates, and we work closely with the firm's loan pricing, profitability, and asset liability management clients. Before we begin, just a few housekeeping items. During the webinar, all participants will be muted. If you have any questions or comments, please type those into your GoToMeeting webinar participant control panel. We will respond to questions at the end of today's session. If we are unable to answer your question during the webinar due to a lack of time, we will respond to your questions directly following the webinar. All participant names and institutional affiliations are confidential and will not be shared with other webinar participants. Today's webinar is being recorded for distribution via both the Austin Associates and our new Loan Pricing Pro websites. The recording and webinar slides will be available for download on both websites approximately 1 to 2 hours after the session is complete. So with that as an introduction, for any of you who are not already familiar with Austin Associates, just a couple of comments about us. We practice in two primary divisions, our investment banking arm and our financial management division. The webinar today is being brought to you by the Financial Management Division of Austin Associates, where our practice areas include asset liability management, profitability analysis, and loan pricing. All of our owners and consultants that are actively involved have been involved in this business for upwards to 40 years. We have 200 plus bank and thrift clients, including credit unions, in 26 states just in this past year. We also have a risk management and technology solution division if your organization is in need of assistance in either of those areas. We began the webinar series back in May of 12, so we've been doing this for some time, and our prior webinars are listed here and are available through both the Austin Associates and Loan Pricing Pro websites if you would care to access that. There are also some additional resources there that you might find helpful as by way of articles and white papers that we've written over the last couple of years. You might find some of that information to be helpful as well. We have two webinars coming up later this year in June and September that you may want to touch on or make a note of going forward. As far as the agenda goes today, a couple of the items that we'll be talking about is we're going to review information on the banking industry as a whole through 2014 with particular care to the community banking trend, our $3 billion and under institutions. We're going to cover some information that we've extracted from our loan pricing client base, what we're observing in their loan pricing practices throughout 2014. And then we also have some interesting information to share that we've extracted from our asset liability management client base with whom we've worked in developing their 2015 financial plans, profit plans, and budgets. And we've summarized the projections of that group that we're going to share some information with you today that we hope you find interesting. Some observations about the trend in the industry for ROE for commercial loan pricing purposes. We've covered that in the past, and we're going to update that for you today as we've seen that move going into the end of 2014. And then what we believe to be recommendations for success in 2015.
All right, Jeff, thanks for that introduction. Welcome everybody this morning. This is Andy Morgan. I'm the other administrator on today's session. I'm going to take us through the first bullet point on that agenda. The next few slides here, we're going to be presenting some trend data comparing community banks, and we define that subset of banks as banks up to $3 billion in assets, compared versus some of their regional bank competition, if you will, and we've defined that as banks with assets between $10 and $100 billion. So the data that we're going to be looking at, you can see the number of banks here. About 100 times the number of banks fall within that community bank category as the regional bank category. The average asset size in the community bank category out of those 4,500 or so banks is $450 million in assets, compared to $48 billion in assets on the regional bank side. You can look at the equity numbers there as well. And this just kind of comparing historical levels of ROE amongst the two subsets of banks. Very comparable here. ROEs at the community bank level just slightly below the regional banks. But in both cases, comparing 2014 versus 2013, there was a slight uptick in ROE. At the community bank level, on average, ROE went from 890 up to 904. So with that background on the groups that we'll be looking at, let's dive into some metrics here. The first graph you'll see on the next slide is the return on equity graph. And all of the graphs comparing community banks versus the regional banks, the green line is going to represent the community bank subset. The tan line or gray line, depending on how it looks on your screen, is going to be the regional banks. So if we look back all the way to the end of 2008, that was really the time when a lot of banks were going through their credit issues. High provision expenses, high other expenses related to the asset troubles banks were going through. ROEs dropped at the community bank level all the way down to about the 3% range there in the fourth quarter of 2009. From that point forward, there was a steady climb back to profitability, both at the community and regional bank level. Regional banks seemed to rebound a little bit faster than community banks. They were up to above 10% ROE by the beginning of 2012. Community banks lagged behind that a little bit, up above 8% at that time point. And then from beginning of 2012, all the way to the end of 2013, beginning of 2014, ROEs remained relatively flat. And then what we saw in 2014, kind of a positive trend for community banks. You can see in the first quarter of 14 an ROE of 841. And then by the third quarter, that ROE was all the way up to 9.5%. And in fact, that was the first time since back in the 2008-2009 period where the ROE at the community bank group exceeded that of the regional bank level. The next graph down is going to compare the yield cost spread. This is analogous with the net interest margin. So we're looking at the yield on earning assets compared to your cost on your costing liabilities. So what we see here, if we're looking back from 2010 all the way to 2013, is at the community bank level, it's remained relatively constant. It was 360 in the fourth quarter of 2010, dropped to a low of 348 at the beginning of 13, and then has steadily made it a climb back from that low back up to the 360 range as of the third quarter of 2014. So, a lot of factors have gone into the fact that you've been able to maintain a relatively constant margin. Obviously, loan yields, asset yields have dropped over this time period, but at the same time, the deposit costs have dropped as well. There's been a mass flow of money into your low or even your non-interest-bearing transaction account, your DDA accounts. A lot of people have been parking their money there in anticipation that rates will eventually go up. And at the same time, you've had a lot of runoff in your CD portfolio. So all of the higher rate CDs have had a chance to run off, and money that hasn't gone into those DDA accounts and maybe been reinvested in CDs have come on at a lot lower rates. So that funding cost has dropped at the same time that your asset yields have dropped. From this point forward, though, that's really the question mark. What we've seen amongst our client base when we've run budgets for 15 is really deposit costs have hit a floor. There's really not any more room for deposit costs to drop. In fact, a lot of our banks, in anticipation of rates eventually going up, have started offering 2% rates on 5-year CDs, maybe trying to attract some money into those longer-term liabilities and locking in some of the funding costs going forward in anticipation of rates rising. Now, at the same time, you're still facing, lots of pressure on the asset side. Loan demand has continued to be on the weaker side. You're flush with liquidity. You're trying to chase a little bit of yield in the investment portfolio, but as we've seen there, rates have not really increased in that area. So it's really been tough in terms of the pressures on your margins for sure. Let's jump forward to the next graph here, and this is really a nice graph that kind of compares what's happened in terms of loan yields. And in this case, we're not really looking at the regional banks anymore. We're just looking at community bank loan yields and how they've fallen over the time frame from 2008 to 2014. And we're really comparing that versus benchmark market rate curves. So what we saw, market rates dropped from 2008 all the way through the end of 2012, and at the same time, loan rates kind of followed the lead there. But what we didn't see as rates began to rise, and you might not even remember this happening because rates have been low for so long, but we actually did see an uptick in the mid to long end of the curve from the end of 2012 throughout 2013 and 2014. Now, rates within the last month or so, the graph only goes to the third quarter of 14, have come back down a little bit. But what we didn't see as the rates rose from 13 to 14, the loan yield continued to drop. And the reason behind that, obviously, is the competition that's out there. Everybody's chasing the same loan deals. The demand still hasn't come back to kind of pre-recession levels. So everybody's chasing the same deals, and it's really been a fight in terms of yield and the yield you're able to achieve on the new loans that you're putting on the books. So even though the market rates have come back up a little bit, loan yields haven't really followed. Now, with that said, it looks like we've kind of hit a floor in terms of overall portfolio yields. You saw in the beginning of 14 on this graph, loan yields overall at the community bank level hit the 509 mark. And then we saw it increase from that point a couple basis points throughout the year 2014. The next graph we want to show you, this just kind of shows you maybe the unfair advantage community banks have versus the regional competitors. And this shows you the spread and efficiency ratios. And for those of you out there that aren't familiar with efficiency ratio, this is basically comparing the level of non-interest expense versus your net revenue. And your net revenue is made up of your non-interest fee income as well as your net interest income. So that's what that ratio means. Lower the number here, the better. So you can see there's always been quite a spread between the community bank level and the regional bank level. The nice thing to point out here is the trend beginning at the end of 13 through 14 is the community bank efficiency ratios have come down quite a bit. In fact, they're back down to where they were at the end of 2008. I think community banks as a whole have done a better job of maybe getting better fee income through some of their ancillary products, being able to control costs maybe a little bit in terms of, you don't have a lot of the loan-related costs that may have been there throughout the 2008, 2009, 2010 period. So that's all helped the efficiency ratios come down a little bit. And at the same time, on the regional bank side, even though they're still quite a bit lower, there was a little bit of an uptick at the end of, throughout the middle and the end of 14 here. So that spread has come down just a little bit. And then the last graph on this slide here, we want to show you this kind of the decline of non-performing loans to total loans. So obviously as, we had all the troubles back in 2008, 2009, this stat really peaked, really skyrocketed. At the community bank level, it reached all the way up to the level of 409 in the fourth quarter of 2010. And from that point, it's really made a gradual decrease all the way to the point where you compare where the community bank level was late 2014, almost back down to where we were before things really went south on us as part of the overall decline back in the late 08, 2009 time period. So we're almost back to where we were pre-recession. The next slide I wanted to go through here. Now we're really going to break apart, not just look at overall loan portfolio yields, but we're going to really dive into the commercial portfolio, and we've broken out the two biggest pieces of that commercial portfolio, segregated commercial real estate versus other commercial loans, C&I loans. So in this case, the green line now represents commercial real estate. The tan line is the C&I portion. So what we see here, again, obviously we know loan rates have come down over the time period we're looking at. Commercial real estate loans have floored out at about 5% in the first quarter of 2014. They've made a little bit of an increase throughout 2014, and we've seen similar increase on the C&I loans. But obviously, if you look at your overall commercial loan yields versus what you think think of what you're putting loans on the books at currently and what the competitive rates are, your new loan volume rates are still well below what these portfolio averages are at. So, unless we get a significant increase in the market rates, market curves here going forward relatively soon, we would anticipate, even though we saw a little bit of an uptick in loan yields throughout 2014, it's going to be a real struggle to get an increase in these portfolio yields going forward. Jeff will touch on that a little bit as he looks through some of the budgeted numbers later on in the presentation. The pie graphs at the bottom of this slide, these are really snapshots. We want to compare kind of what your portfolio mix looked like in 2008 versus today. In a lot of cases, it was very similar. Couple things to point out here. Commercial real estate loans as a percentage of your overall loan portfolio increased significantly, went from 24% up to 30%. Saw a similar increase in 1 to 4 family loans. That might have been due to the fact that the secondary market has softened a little bit. Maybe you've decided to hold some of those loans on your balance sheet. So that has gone up a little bit. And on the flip side, we've seen a decrease in your consumer loan portfolio. That was at 22% in 08. That only makes up 12% of your portfolio today. So bigger concentrations in commercial real estate, 1 to 4 family, and your consumer portfolios have gone down quite a bit. So that's some of the industry trend data that I want to go through. I'm going to throw it back over to Jeff now, and he's going to walk us through a few more slides on industry data.
So if we look at the growth in the two primary product areas that make up the commercial loan portfolio, if we look at CRE loans, commercial real estate loans, we've got about a 2.5-year period of time here that we've charted. And there were a couple of specific time frames where there was particularly large growth. The second quarter of 2013 and the fourth quarter of 2014 represented rather dramatic periods of growth. The next strongest period of time was the fourth quarter of 2013 when the commercial real estate loan portfolio was growing. Back at the beginning of this time period that's displayed in the chart for you, we were at $342 billion across the community bank industry in commercial real estate loans. That grew to the end of third quarter 14 to $389 million. Across that 2.5-year period of time, that's about a 14% rise in those balances. The CAGR on that, the compound annual growth rate, would be just slightly north of 5%. So the commercial real estate loan portfolio across this time frame has grown just a little bit more than 5%. Now, on the bottom of this slide, we show the same information for the C&I loans, and you notice that the annualized growth trend here is a little more choppy, a little more up and down, quarter to quarter. these are cash flow loans, cash flows of our businesses that are our primary customers vary greatly from period to period. Draws on loans, draws on balances are adjusted. It's been a period of high liquidity, so a number of companies have paid down C&I loans at points in time that our client base has not really expected that to happen, and as we've seen both growth and decline in the portfolio on kind of a seasonal basis. Across that same period of time, as I mentioned, this is the smaller of the two products. It was $147 billion in balances back at the end of the second quarter of 12, grew to $177 billion at the end of third quarter last year. That's a 20% growth rate across 2.5 years, and it comes out to a CAGR of just about exactly 8%. So the C&I loan portfolio, while it's smaller, has been growing at a faster rate than the CRE portfolio. The CRE portfolio still remains much larger by comparison. The next thing we wanted to take a look at is the OCC does a survey of credit underwriting practices. They ask commercial lenders to kind of give some subjective input as to how they see underwriting standards being tightened or eased in their individual institutions. So if you look at these three data lines that are plotted, at any one point in time, the sum of the three will always equal 100%. So, for instance, at the end of 2009, 86% of commercial lenders reported that they had experienced a tightening of their commercial underwriting standards. 14% had reported that their underwriting standards were unchanged year to year, and no commercial lenders at that point in time reported that they were easing commercial underwriting standards. So that was the significant period of time where underwriting standards were tightened. From 2007 through 2009 was a significant period of tightening. And pretty much since then, what we've seen is an easing of credit underwriting standards. And that's fairly consistent through the end of 2014. There seems to be a reduction of standards. There's been a reduction in the increase in the reserves needed. There's been a reduction in provision for loan loss expenses on community bank income statements, to the point that many community banks experienced income through their provision for loan loss line item in the previous 2 to 3 years. But possibly what this information is saying to us is that things are starting to look like they could be changing again. The final bullet point on that slide reports that 27% of loans in 2014, compared to only 19% of loans in 2013, showed signs of increased credit risk. So that is an indicator that existed back in the time frame of 2014, 2016, prior to the onset of the Great Recession and prior to the increase in credit issues, credit problems for community banks. We need to be careful that we're not heading into that situation again today. Of course, no one knows, but we're so focused on growing the loan portfolio and trying to maintain and or improve commercial loan yields. This is something for us to not take our eye off that ball, is the credit underwriting issues within our organizations. The next set of slides that I'm going to enter into here, some information we've taken from the American Banker, and thank them very much for having that available for us to look at. This is their index of banking activity, and what's important on this, the first of this series of slides, is that blue composite line. And the way these graphs work is they're charting changes in activity across. This again is about two plus year time. It's not a full 2.5 years, about 2 years and a quarter. Across this time frame, that composite is a composite of a number of factors, and you can see them sort of listed there at the bottom. Commercial loan applications, commercial loan approvals and rejections are included in that blue composite line. Commercial loan pricing as an impact to the overall index of banking activity is included, and commercial loan delinquencies are included in that as well. And we're going to touch on each one of those pieces just to try to get a little bit of a sense of, what's really going on in the activity levels for commercial loans in commercial banking overall. A couple of periods stand out here when we look at the gray line here, which is commercial loan applications. It appears that the first quarter of the last 2 years have been very heavy volume quarters from the standpoint of commercial loan applications. You see that peak that starts in February 13, runs through May of 13, before dropping off in June. And then you see a similar type spike in the first quarter of 2014. February and March were very high periods of time there for commercial loan applications. So, and then the way we look at this, the way the American bankers put this index together, is readings of 50% or above indicate expansion. Readings of 50% or below represent contraction. So before I leave this chart, if we look at what's happened since March of 14, it's been a relatively steady decline in commercial loan applications through November of 2014, and it's to the point that it's actually touched that 50% baseline, indicating it could possibly be headed for contraction. So there's a negative trend in commercial loan applications affecting the composite index there. The composite index on an overall basis is just flattening out, but the impact of the commercial loan application decline is pretty significant. So that's why we started with that one. On the next slide, we look at commercial loan approvals. And we're looking at the orange line here relative to the blue index or blue composite line. And we see a fairly similar pattern, a spike in the first quarter of each of the last 2 years, and a relatively steady downtrend in approvals, not, however, to the same point as applications. Approvals are following that same trend, but are not near the 50-point benchmark on the scale, so not quite as negative of a trend as on the application side. Commercial loan rejections are a little bit harder to track. It's very choppy here, and this element of the overall index operates in reverse to the other two that we've looked at. When rejections decrease, that's actually good, and that's being plotted in the upward direction on this chart. When commercial loan rejections increase, that's a negative, and it's charted down in the direction down towards the 50-point benchmark on the curve. Very, very choppy. An overall trend in the last, say last 9 months, that is headed in a negative direction, similar to what we saw with applications. So that's what the rejection data is telling us is one component of the overall index of banking activity. And then the delinquency data generally is happening at, it's a very choppy data series, again, but it's occurring at a level above that of the composite. So there's been a general decrease in the trend of delinquencies. It's putting a little bit of downward pressure on the overall index, but there is actually some help coming to the overall index from that. And then the final of these American Banker slides, looking at the various components making up the index of banking activity, is the impact of commercial loan pricing. And what this is a measure of the competitiveness and the measure of how low loan prices, commercial loan prices, have gone relative to the banking activity on an overall basis. And what we see here is that from June of 12 through about the end of the second quarter, 13 was a very, very tough point in time for commercial loan pricing. We got back above the 50-point benchmark in this index for a brief period of time on the second half of 2013, fell below, as overall volume and increase in activity of the first quarter of 14 was a favorable trend. The impact of commercial loan pricing was actually negative. We gave up yield to gain volume is what essentially happened during that period of time. There's just been one slight period of August of 2014 when we've been above that 50-point benchmark for a very short period of time, and then we've fallen below it again from a pricing standpoint in the last couple of months of 2014. So we are still in an extremely competitive, price-sensitive point in time here from a commercial loan pricing standpoint. And we thought that was some interesting information to share. I know it's that's data that supports the real life experience that probably each one of you as commercial lenders or senior bank management, you live that day in and day out. But there's the data from a large sample size that kind of helps you understand that you're not alone going through that situation.
All right. Switching gears a little bit now, the next few slides we're going to go through are going to be based on actual data from our Loan Pricing Pro clients. So, the subset of clients that run our loan pricing software, we've gone through and extracted data in terms of rates, balances, a lot of different information based on the loans that they're actually running through the model and originating and end up in their portfolios. So a little bit different in terms of the way the data is presented here. The years that you see, 2009 through 2014, this isn't really your trend data. This is going to actually give you data on loans that were either originated during that time frame or loans that had the opportunity to have the rate reset. So if you think of repricing dates, or you made a rate concession for a customer and the rate change dates changed on your system, that data would fall within each one of these years here. So keep that in mind as we go through the data here. The other thing to point out on these graphs, we've excluded floating rate loans from this data. This is really just looking at your term loans. So we'll keep that in mind as we look through the data as well. So what we see is similar to your overall portfolio loan rates, loan yields. The loan yields on your newly originated loans and loans that have repriced has also declined from 2009 to 2014. Competition has really driven new loan pricing rates down over this time period. We did see a little bit of an uptick on the C&I loans beginning in 2012 through 2014. So actually, in the year 2014, new volume rates on those C&I loans were 470 compared to 453 on the commercial real estate loans. If we look back to 2012 on this loan yield graph, the spread between what your overall portfolio yields were compared to these new volume rates stood at about 100 basis points. That spread has really come down as we've started making more and more loans at these lower rates. At the end of 2014 here, that spread was down to about a 50 or 60 basis point number. So even though your overall portfolio yields are still above these new volume rates, the fact that we're putting on all of our new loans at these lower rates is really bringing that spread down quite a bit. The cost of funding graph on this, or the loan funding cost, the way we've labeled it here, that's not really your internal bank funding cost. So don't think of that as your deposit cost base. When you implement a loan pricing model like our Loan Pricing Pro software, what you're going to do a lot of times is you're going to compare the loans that you're putting on the books versus a benchmark curve. And a lot of times our bank clients use a publicly available curve such as FHLB or a LIBOR swap-based curve. And we're really trying to match the term on those loans that they're pricing to the like term on the funding curve they decided to use within their model. So what we've seen in terms of the way funding cost has been applied to these loans that have either been originated or had a chance to reprice during these time periods is the funding cost really came down throughout 2009 to 2012. So that really runs in parallel to what we saw on the slide a few minutes ago comparing portfolio yields to the benchmark Treasury and FHLB curves. You know, those rates on those publicly available curves really dropped from 09 to 12, and then they started to increase from 2012 through 2014. So the funding cost being applied to the loans in a modeling process increased from 2012 to 2014. It hit a bottom of about, I'd say, 125, 130 in 2012, and then it's back up close to 2% now as of the end of 2014. Both commercial real estate and C&I loans are just slightly below that 2% number. So the impact that that's had at the margin level as you're pricing loans through a loan pricing software, the loans reached their highest margin in that 2012 period as the funding cost floored. Rates were still coming down, but the funding cost was dropping as well, so we saw the highest margin in that time period. And then from 2012 to 2014, we've seen a decrease in the margin on loans priced through the software as funding costs have started to increase again. The market rates have come back up. Loan yields have not come back up. You continue to price loans and put loans on the book at lower rates, so the margins on those loans have decreased from 2012 to 2014. We're not all the way back to the levels we saw during 2009. That's when we had the highest funding costs within the date range that we've selected here. But it's getting back close to where we were there in the 2009 time period. The next slide here, this gives you some interesting data in terms of how you're structuring some of your term loans. So this is comparing over the years 2011 to 2014 the average term on the loans that our bank clients are making and originating and putting on their books. So what we've seen during that time period is a drop of about a year in terms of the term. The overall average term on commercial real estate loans in 2011 was 72 months. C&I loans and other commercial loans was 66 months, so anywhere from 5.5 to 6 years there. And the trend that we've seen amongst our client base and the data, that's dropped all the way down, actually below 5 years for the first time in this time period. Commercial real estate loans, the average term of 59 months. Other commercial C&I loans down to 53 months. So, we still are hearing a lot, some pockets, some clients coming to us pricing 10-year fixed-rate loans through the model, but that's really an outlier. Overall, the term on loans has dropped a little bit over this time period. And you can see the percentage of the portfolio that's made up in the second graph there, the percentage of loans that fall, that have been priced and put on the books with terms 5 years and longer. That has declined over that time period. Commercial real estate loans, that's still, biggest portion of the new loans that you're pricing are at least 5 years or longer. It still remains at above 70%. It was all the way up in the mid-80s back in 2011. Other commercial C&I loans, you're down around 42% now in terms of loans that are 5 years or longer in term. The next slide just kind of summarizes a lot of the data that I went through. I won't go through each one of these right now. It will be there in the slides, though. If you feel free to download and read through those at a later time.
So the next thing we like to touch on is each year, about somewhere between beginning in November and the end of December, Austin Associates works very closely with our asset liability management clients and helping them prepare their coming year profit plans or budgets. And we wanted to share, we did a very systematic analysis of that information on an aggregated basis this year, and we wanted to share some of the findings with you on that. It's kind of the general thinking of community bankers as they head into the new year. You know, how does your budget and how did your expectations compare to that of some of your peers and colleagues across the community banking industry? One of the things we thought was very interesting was across the entire sample size of our client base that we assisted in the budgeting process, not one forecasted a decrease in either their loan or deposit portfolios. We thought that was pretty interesting information. On an overall basis, our client group is expecting the loan portfolio to grow 7.6% in 2014. Prior year loan portfolio growth has been either negative or in the range of up to 5%. So the 7.6% indicates a level of growth higher than what we've seen in the last couple of years, but probably not enough to really become what you might call robust growth leading towards increased levels of profitability. Within the overall loan portfolio, business loans are expected to grow faster than other loan types. Despite the growth in balances, however, the sum across all of our clients is that the overall loan yields will remain almost exactly unchanged. You know, individual clients have small increases, other clients have small decreases. Across the group as a whole, loan yields are expected to remain unchanged. On the deposit cost side, a couple interesting things came out here. 53% of the clients that we assisted in the budgeting process expect their deposit costs to rise in 2015 relative to 2014. And on average, the banks that expect an increase in costs expect that those costs will go up by 10 basis points across the year. The banks that expect deposit costs to increase were, in general, much larger than the banks that expect their deposit costs to fall, and that was 43% of the group. And on average, the smaller banks that expect their deposit costs to fall are expecting a 3 basis point drop in overall costs. So while we think that we're at a floor or near a floor, there are a few that are suggesting that it could still go lower, will go lower for them in their markets, but in general, those are smaller banks within the mix. The net interest margin is expected to expand just slightly, and it's primarily due to a favorable mix variance in the cases that are driving that, where the loan portfolio will become a larger portion of the total balance sheet. There's a positive volume variance because of the 7.6% growth. And there's a favorable mix variances. There's more loans and fewer investment dollars in the balance sheet. But overall, just a slight expansion in the net interest margin is expected. Provision expenses are anticipated to rise, and these were to rise about 12% on an overall basis, and that's consistent with the new loan growth that's being put on, and not surprising given the relatively low level of provision for loan loss that we've seen in the last couple of years, and certainly in 2014. It's not a bullet point on the slide, but I'll just add that non-interest income is expected to rise just under 6%, and non-interest expenses are expected to rise just over 6%. Salaries and wages being a major area of cost increase. Regulatory compliance issues, we believe, are driving a lot of that. And then on an overall basis, both years, 2014, projections for 2014, final numbers, and budgets for 2015 are coming in for this group at 90 basis points of ROA. So no change in ROA on an overall basis for the group. So what we wanted to do is kind of break that out by size. The bars on this graph are really just telling you what our sample size looked like by client size or bank size. About 39% of the sample are banks in the 250 to 500 million asset class. And the shape of this is almost a perfect bell curve. 21% of the clients are 100 to 250. 11% are below 100 million, and going to the other side of the graph, 11% are over 1 billion in asset size. About 18% of the group is 500 million to a billion. But really the more telling information here is that gray line on the graph. Our clients under 100 million in assets have ROAs for their 2015 budget of about 42 basis points on average. Our clients in the 500 million to 1 billion asset class have the best ROAs for their budget year 2015 of 1.06%, the average being 90 across the entire group. So we thought that was kind of interesting to see the breakout. Size matters. Growth by loan type, we've touched on this a couple of different ways, but the forecast for 2015 going forward, our client group thinks that the CRE loan portfolio will continue to grow at about an 8.3% rate, a little bit higher than the average, and C&I loans are expected to grow at 13.6%, significantly higher, almost twice the average of the loan portfolio overall. Now, we looked at the expected yield changes by portfolio, all the different pieces, parts and pieces of the loan portfolio on an overall basis. Across the entire loan portfolio, the expectation is that overall yield will not change. Now, individual portfolios within that will go up and down such that the overall loan portfolio yield remains roughly unchanged. The CRE loans are expected to have the highest overall increase in yield at 4 basis points, a very, very small 4 basis point change. The expectations across our client group, however, we had some individual clients budgeting their CRE loans to drop 19 basis points in yield and others to grow by 37 basis points. So the greatest degree of dispersion in budget forecast for yield changes occurs in the home equity loans. They're expected to be up 2 basis points overall, but within individual clients, we have as much as a 1.25 percentage point increase or a little bit more than a 1/4 point decrease. And then C&I loans are expected to drop 4 basis points. Mortgage loans are expected to drop 4 basis points. Other ag product types are expected to drop 5, and consumer installment loans are expected to drop 5. But there's a great degree of dispersion amongst our clients. 86 basis point improvement in some clients on consumer installment loans, and as much as 46 basis point drop on other clients. The effect of all of this on the bank-wide net interest margin, that the loan portfolio is just a piece of that. As we see the loan portfolios growing, we also see the investment portfolio shrinking. A fair degree of that 7.6% growth in the loan portfolio will be funded by existing liquidity. About a 2.6% drop in the investment portfolio is what's included in our client budgets. But what this shows is that there will be a small increase in interest income from 3.61 to 3.65. This is interest income on an average assets basis. Interest expense across the group as a whole will remain roughly constant at 40 basis points, such that the margin will expand by just 4 basis points on an overall basis. So that's the summation of the budget expectations for the net interest margin across our client group. So where we kind of want to start wrapping up here is thinking about, it's going to be a tough year. There are some improvements slated. We are anticipating for a little bit more growth in loan portfolios than we've seen in the past. We're seeing forecasts for positive mix changes as loans grow, and that's funded out of existing liquidity. What do we expect to have happen in the ROEs that we're able to target for new loan pricing decisions and refinance of existing deals that we have to look at. The longer-term history is that when banks as a whole were earning 15% ROE prior to the onset of the Great Recession, and then fell and then recovered back to about 9% ROE as of the end of 13 and going into 14. What we saw happen in the commercial loan portfolio is when we were previously able to target 18, 20, 22% ROEs on commercial loans, the industry has basically repriced so that we're targeting only about 12% ROE on commercial loans. And when the bank as a whole is only earning 9%, that's still favorable. You can grow commercial loans at 12% ROE and still improve your bank-wide ROE, but you're never going to get back to the 15% ROE that we had previously doing that way. We've also seen individual banks not holding to ROE targets based on their current portfolio average of their commercial loan portfolios, meaning 12%, but pricing commercial loans on an incoming basis at any level north of their current bank-wide ROE, which for some banks is 6%, 8%, 9%, down that range. So again, those are all factors leading to continued extremely intense competitive pressures pushing down ROEs.
Okay, and we just wanted to go through a few things. We did this during our last webinar, just some key strategies going into 2015 in terms of commercial loan pricing. We consult with our bank customers and implementing our model, kind of calibrating the system and setting it up. The biggest thing we're running into lately is, how do we set ROE targets within the model? And a lot of times you're going to go through a process where you want to set targets and try to calibrate your model in such a way that you know what your existing return levels are, not only on the bank as a whole, but as Jeff just said, what do your ROE levels look like on the commercial portfolio? But then you want to take it maybe a step further to say, what do my current ROE levels look like on individual products within my commercial portfolio? So we have a lot of our clients in this day and age that are actually setting different ROE targets based on product type. The goal within a modeling process should be to obviously move the needle in a positive direction. If your current commercial portfolio is returning 12% ROE, the goal should be to try to move that to 13 or 14% going forward. But within that portfolio, you're going to have products that are currently returning 5%, 7%, some that are above your average. They might be 18 or 19%. So it's important to be able to set targets within your model based on what the current return levels look like on those individual products. So we always recommend against setting single numeric targets within your model. The other thing, oftentimes when we go out and we do training on our model and we start looking at full customer relationships, we'll bring up a relationship within the process that has a certain level of ROE. And as an example, you might bring up customers within your model that currently return 20 or 25% ROE for the bank. In cases like that, you have to be careful when you're comparing that versus the targets that have been set. Obviously, if you have a current customer that's returning 20 or 25% ROE, the goal would not be to try to drive them to a target of 12 or 13% or whatever has been defined in your model. If you have a very profitable customer like that, a lot of times you're going to want to work with them in order to keep their business at the bank. You might have to sacrifice a little bit ROE. Maybe they move from a 20% to a 19 or 18%. But the goal should never be to always try to move exactly to your target if you're currently above that target level. On the flip side, if you have customers that are currently well below your ROE targets, you might not be able to get them up to a 12 or 13% target in that next incremental transaction. A lot of times what we recommend in a case like that is, if they're currently at 5, 6, 7% ROE, what can we do with that next transaction, that next pricing opportunity in order to move that needle in a positive direction? Let's move them from a 7% up to 8 or 9%. move them closer to that target level. So that's something you want to be careful of as you start implementing models as well. So that's kind of, a little bit of recommendation going into 15 in terms of loan pricing by itself. Jeff, do you have any more comments in terms of summarizing today?
In our past two webinars back in 2014, we modeled individual loans currently being considered by webinar attendees, and those are available for viewing on our Loan Pricing Pro website if you'd like to do that. If you have any new or extremely difficult current loan pricing situations that you'd like to see modeled, please feel free to email either Andy or I, and we'd be happy to walk you through some of your most difficult pricing decisions that you're grappling with today. But other than that, I'd just like to thank everyone for attending.
Yeah, I'm looking through the question box here. It looks like everyone was shy today. We don't have any questions typed in the box. As we mentioned at the beginning, if you want to talk one-on-one after today's session, feel free to reach out to Jeff or myself, and we'll be more than happy to answer any questions you have, either about the information presented today or any other questions you might have in terms of how you're pricing loans and a modeling process that you either have in place or are thinking about putting into place. So again, like Jeff said, we thank everyone for attending today's session. The session was recorded. We will get it up on our website momentarily, along with a PDF copy of the presentation slides. Hope you all have a great rest of the week, and again, thank you for attending today's session.